Hello, everybody, and welcome to. Oh, no, it's not the eye, is not there yet. Hang on. Wait for the eye. There's no eye anymore. All right, maybe we're going. Hello, everybody, and welcome to Selfwealth Live, our technical analysis edition. If you're wondering and if you're seeing this few comments that I made at the start, normally we're waiting for a flashing eye to come up. Oh, now the eyes come up. Maybe I should start now. Hello, everybody, and welcome to Selfwealth Live, our technical analysis edition. I think this is take 3. We're about to start here. So, welcome, Jason. How are you today?
Hey, Rog, I'm good. Geez, plenty of stuff going on, hasn't there? And probably got quite a bit to go through today.
There's a bit to go through, but before we do, talk about the negative days, the big negative days of the last 3 days in the stock market, start off August, I just want to say congratulations to you and to myself, obviously, for going for 1 year this week. This will be our 1 year anniversary. So well done, Jace. Good work.
Yeah, 1 year. It's flown by, hasn't it? So I'm sure we've got a few viewers from like a year ago, and hopefully we've been interesting and helpful during that period. And for all the new people we've collected along the way, yeah, I hope you like what we do here on a Tuesday lunchtime, talking about markets and hopefully getting some ideas out there.
Yep, and you've survived my banter, and you've survived my my questions, whether they be silly or good. I'm not sure. So you're still here. That's the main thing, Jason. Right?
Oh, look, I always say there's no such thing as a silly question. It's when it comes to the markets, like no one knows everything, and so if there's something you're thinking, and of course there's something the viewers are thinking. It's like chances are there's a whole bunch of other people thinking the same thing, and just ask the question and see what comes back.
Yeah, and thanks everyone, the guys that have been here for the start, or the guys that might be the first show here today. Thanks for rocking up and coming to see us week on, week out. If that's you, really appreciate your support, and don't forget always to like, subscribe, or put comments below as well. That just it keeps us fueled and keeps us going, right? So just as you, if you didn't know, and you are sort of at the beginning stage with our show, the way we started off was kind of like we had like a 12-week sort of planned program where we went through from like a beginner trader and how to analyze the markets from a technical analysis position, right? We don't really talk too much around fundamental analysis, because there's plenty of that out there in the world. I think technical analysis is one of those ones, especially stockbrokers in Australia. There's not a lot of it, not a lot of education around it. I'm not sure why, but because a lot of people use it, obviously. So when we first started the show, if you look back, you can go back and look at some of the replays. And at the first 12 weeks, I think it was 12 to 14 weeks, was a structured plan to get you going and learning all about technical analysis. And I really love doing that part. And then it sort of evolved. This show sort of evolved into a live show on us analysing the 3 major markets that Selfwealth offers, which is the Aussie market, obviously the US market, and the Hong Kong market. As well as general questions coming to us. We'd answer general questions, so you can always send your questions in. And then we would have a spot at the end where we'd analyze your tickers, the tickers that you're interested in, or your stocks, that you might be interested in, and we would give you our point of view from a technical analysis position. And that's obviously Jason's through Jason's 30 years experience in the markets. I don't know where else you would get that for free, effectively. So it's been great. It's been great so far. So all right, without further ado, Jace, before we get going, let's have a look at the disclaimer, please, because that's the most interesting part of the show, right?
So everything today, general commentary only, no personal advice given. And let me just quickly put up that disclaimer, which you mentioned a moment ago, and that just goes through all that. I'm also not part of Selfwealth. I'm Motion Traders, my business. You can see all my licensing details in the top portion, all Selfwealth's licensing details, general advice, etc., in the lower portion. So that's what we're about today. General commentary only.
Okay, fantastic. Thanks. Thanks. Once again, Rodney, James, Mark. I'll go through a few names here: Mehdi, Talwin, because they are some familiar user or handles. Whether your first name or handle. Talwin, Makus, Rodney, Kirby, Thomas, and Abby. Thanks for being loyal viewers. All right. Please, Jace. Let's explain to me why has the last three. Well, yeah, maybe you don't know why, but let's look at the ASX market, please, and let's have a look what the structure is.
Yeah, well, I think let's start with those charts and see what has been going on. So I've got the first chart, the ASX 200, and what an extraordinary day to be talking about the markets with all this price action going on, and particularly in the last 3 days. So the ASX 200 gone from an all-time high on Thursday. This is extraordinary. All-time high on Thursday to an 8% pullback just within 3 days. And it's so rare that we get situations like this where the market cycles from an all-time high to an 8% or thereabouts pullback in such a short period of time. And to put this into perspective, the sell-off that occurred during the COVID period, the COVID crash, to get to the same point where the ASX 200 is now, it took 5 days, and this one's happened in all of 3. So that's why I say it is quite an extraordinary situation. And just to be clear, when I make that comparison, I'm not suggesting that the current sell-off is setting up for a magnitude decline that we saw during that COVID period. I think that's a low probability event. That was a global shutdown. This is nothing of the sort. But just seeing that the speed of the decline, that's the point I'm really emphasising. And but this is just one of those standout declines from an all-time high. And when we look back over the decades, this is a notable one. The focus. So just looking at what the focus has really been in the in recent weeks, even recent months. Look, in recent weeks, the focus has been on this breakout. So we've had in recent months, we've been looking at this this trading range, had the breakout, initial pullback, started to rally again. All that was looking good up until Thursday. So up until Thursday, this was very much a bullish chart structure, and we had a clear bullish breakout. But what we now have is very much a false break. Market's broken higher. It hasn't held that breakout, and now it's collapsed back down well within the old range, and even approaching the lower end of the range. Another name for a false breakout. It's an interesting name. It's called a bull trap. So a bull trap. So you think of that. You get a breakout. People get bullish and they buy, and then the market quickly retreats, and those bullish are left holding their shares at higher levels. So hence they call it a bull trap. And I'm one of those bulls that got caught in the trap, because I bought some ASX 200 ETF to add to all my individual holdings near the breakout point. That looked good for a few weeks. Now it's come back down. So hence you get that name, a bull trap. And of course, all my individual stocks. So didn't just load my individual stock portfolio up in the breakout. I'd been buying stocks all the way up. So a lot of those stocks are well in profit. And that's been a case of just letting those earlier profits run, wide trailing stop to manage risk. So where does that leave us now? Well, these I think this sharp decline, it does do a lot of technical damage, and when you get damage like this, it does typically take some time to repair. I think at a minimum, I think this is part of potentially a longer consolidation that could stretch out for several more months. At this stage, when we just compress this all up and we look at it, at this stage, the overall structure has not turned bearish. So I know these sharp declines they're unnerving. All over the headlines, worst period since 2020, and this is what we were talking about earlier, worst period since back in that early stages of that COVID decline. But sharp declines don't always lead to a bearish phase. So it's interesting. I'll just quickly show you a couple of examples from earlier periods. I just went back through the charts and looked for setups which are not dissimilar to what we currently have. And so here's one from back in 2013. So the market made a new all-time high and then very quickly fell back to the moving averages and below, then stabilized, then continued to rally. There's another one from a couple of years later, or 2014, new all-time high, very quickly declined back below the moving averages. And these are declines of around 10%, so a little bit larger than we currently have. So headline making declines. There's all sorts of examples you can find when you look back through the charts. Here's another one from 2018, again, new all-time high, and then a quick cycle down to a 10% decline. Then the market rebounded, took a little bit of time to stabilize. As I was saying, technical damage can take a little bit of time to repair itself, and then it went off to new highs. So I don't know whether the market's going to do the same thing this time, but it's just the point with that is to say that a sharp decline doesn't necessarily mean there's a new bear market underway. Now, of course, a bearish phase could develop. And I think the next rebound we get, the next rebound is going to probably tell us a lot. So we often when we get these quick declines, there'll be a rally back towards the moving averages. So I've got the 50 and the 100-day moving averages. You get these declines, often you get a rally back towards the averages. So I'll show you what I mean by that. There's a good example from 2022. So again, not dissimilar. Really, it was a sharp fall down to the lows, and then over the next several weeks, there was a grinding rally back towards the moving averages. So what would be a concern would be to see a rally that did look something like we have in this period in 2022, because you can see it's quite a lackluster rally. It doesn't really gain any momentum. It's choppy, it's overlapping, and it stalls at the moving averages. And you get the rally because you get buy the dip. People come in and say, oh, look, I can get stocks at a bargain now. So buy the dip comes in, because that's the psychology from the previous up leg. People are conditioned to buying stocks when they pull back, and they're rewarded with stocks rallying within the upward trend. So they continue to do that. That can cause a rebound. And then I say the risk is that you get that lackluster rebound. Stocks are then consolidating below moving averages, which then can turn and start to move lower. And I think this is when the real vulnerability comes in for an ongoing decline. So we don't have this set up at the moment. All we have at the moment, we've got a sharp decline, but what happens from here? Does it stabilize and start to go back higher, or do we get this sloppy rebound below moving averages which cross to the downside? That's when things, I think, get the most concerning, at least for me. At this point, we don't have that structure. All we've got 3 down days. So where does this go? I think here and now, I think it's a case of not panicking, but I do think it's worth taking some steps maybe to de-risking a portfolio. And by that, I mean maybe clearing out some of the stocks that are hitting exit levels. If you're using stop losses and trailing stops on your portfolio, looking at those stocks which are hitting exit levels, getting rid of them. Maybe if we get a rebound, that could also be an opportunity to just lighten up on some stocks that maybe you have in the portfolio, but maybe they haven't been doing much. Maybe they've been relatively weak stocks. You've been putting off selling them. Maybe if we get a rebound, that could be the opportunity just to lighten the portfolio, de-risk it a bit, convert some of those marginal stocks to cash, if we get that sort of rebound in the next couple of weeks, that could open up that sort of opportunity. But I don't think it's a time to rush out and just to panic selling. Rather, I think it's currently a case of more of an orderly cleanup and risk reduction at this stage. Now, that can change. As I say, we get that sloppy rebound to the moving averages and then prices start to roll, then it's another game. We've got stop losses. Well, hopefully people have exit strategies in mind, and then those stops start hitting, and then you start building more and more cash and getting out of stocks. But that's not where we are at the moment. As we've seen from past situations, this market could stabilise, and then by the end of the year, the market could be at new all-time highs. It's entirely possible. So that's why I say I don't think now's the time to just go complete panic and just sell everything. My approach is to stay long, but just scale back risk, as I've been saying. I'm also not buying the dip. This isn't a dip that I want to buy at this stage. I want to wait for clear setups before buying anything, and I've got no interest in trying to pick the low. Lots of people want to try and get in the lowest point, but we don't know. This could develop into something larger. We don't know. We're just trying to manage the price action as it develops. And Rog, I tell you, this is exactly why share investing is so hard. It's all good. It's all well and good when we've got this big sweeping upward move that goes on month after month, and we log in, our portfolios going up, and we see green everywhere. Everyone feels good about that, and that's the straightforward part. It's when we get these down periods, that's when uncertainty can make things really difficult. When things go into reverse, it can become a real emotional strain. And I think this is why a trading plan is just so important. There's lots of people out there now, I'm sure, without any plan whatsoever, other than what they're seeing on the news. And that's just it's just an awful situation. What do? You don't have a plan. The plan was, my portfolio is going up, but now it's not. Now what do I do? And I often tell my motion trader members that we don't know what the market's going to do next. So I can't tell you where the next move in this market's going to be. But if you have a good trading plan, a good trading strategy, then you'll know what you're going to do no matter what happens, because that's all part of your plan. So, look, I think that's where we are at the moment.
Yeah, and I like seeing some of the comments, which I'll read out soon. Like, people have already got, I can see on here, they got plans, right? Whereas if I mentioned last week, I started having a look at some of the social media groups out there. I think it was on Thursday or Friday, someone, posted that they're down $100,000 and asking for everyone's opinion on what to do, right? And then 7 or 8 people post their opinions, and I don't think that person would be better off with all the different opinions, right? So they went in the market hot and as beginners and thought, oh yeah, right all the way up high. But then what are they doing now with the $100,000, drawdown, right? I don't think they were realised losses, right? So they just didn't know how to manage it now that they're $100,000 down, right? So, but it's good to see. And then obviously what makes a market is that when I speak to clients that aren't into technical analysis, these are the perfect situations for a lot of people, because they're looking to load up now. Now that the market's gone down, right? So, but as you say, Jason, I think it's, whether they're trying to pick the bottoms now and are going to be successful there, and then they might be listening to people going, yeah, now's the time to get in because everything's just down, everything's been priced down. But then do they have an exit plan if it drops even further, right? So that's the question, right? So it's interesting. It's very interesting to see have everyone's different opinions and whatnot. But I'm glad on our show we teach to have that plan and make sure you come up with a plan yourself based on what you learn, right? So it's good. You don't need to comment on anything I've just said then, Jace, by the way. But let's have a look at the US market, mate. Let's have a look at the US market.
Okay, and we'll jump over to the S&P 500. And, well, hasn't this quickly evolved into something larger? Last week we were talking about how the market appeared to me at any rate to be a routine pullback back to the 50-day moving average, as we often see during an upward phase. So the balance of probability for me is that when a rising market comes back to the 50-day moving average, you say the path of least resistance is up, it's a pullback, stay long, wide trailing stop, let profits run. But of course, at some point, there's going to be something larger develop, and that's what we've seen in the last few days. S&P's come back to the 100-day moving average, and now on Monday's trade has fallen below there, and much of the volatility's been in those big tech stocks like Nvidia. So here's what Nvidia looks like. This is why I don't like to buy stocks when they get stretched above moving averages, because gravity always wins. It always pulls them back down. And this has been down as much as 35% from the high just, where was that? That was the 18th of June. So in less than 4 weeks, it's lost as much as 35%. You see similar losses along some of those other big tech names. And that's what's causing so much volatility in the that's largely what's causing so much volatility in the S&P 500. It's down about 10% from the highs. As I was saying with the ASX 200, these swift moves below the moving averages, they don't necessarily mean that a bear market is starting. And again, I think the next rebound, at some point there's going to be a rebound back towards the averages. What that looks like, I think, is so important. What I don't want to see is something like what we saw in 2022. So just looking at this period where the market sold off quickly. So again, all-time high. We had a quick reversal, rallied back to the moving averages, which had started to trend lower, stalled at that point, and then started to continue to decline from there. This is the point of vulnerability when markets stall below declining moving averages. And then from there, the downtrend developed. But the downtrend didn't, you couldn't say the downtrend had started in the first couple of weeks of the decline. It really only became evident as the price action started to fill out. So that's what I don't want to see happen here in terms of, like, can this be a market that recovers and keeps moving higher in the months ahead? So that's a sort of price action that I'm on the lookout for, and that sort of structure which I was talking about from 2022. This is where it changes from. You have buy the dip when a market is rising above rising moving averages. Markets pull back. Buy the dip works well, but once a market gets locked in below these moving averages, then it becomes a case of buying the dip doesn't work, because the market will often keep dipping until eventually it makes a low, but you don't know when it's going to be. So it becomes a case of sell the rallies. And this is what I was talking about, the ASX 200. If we get a rally back towards the moving averages, maybe that's the opportunity just to lighten up on some things until we get a bit of clarity about what the underlying trend is going to be coming out of this. So it's that's how the structure can change. When we get below moving averages, then it can become a case of sell the rallies. Also looking at the S&P 500 on an equal weight basis, which is interesting to have a look at. And similar to the ASX 200 in that we've got this big false breakout, and now we've got a pullback back within where the previous range has been. At the very least, I think it takes time to repair the technical damage. This market could stabilise somewhere within the general region, but then I think it does need some time to back and fill and rebase before we can look for a potential upturn. But the false, I think, and this is the same with the ASX, the false break is a concern, because breakouts are often strong setups that attract follow-through buying. And when they fail, it can be a warning that the underlying trend is changing. So I think there's definitely reason for caution and de-risking, not getting out of the market completely, but I think de-risking. And as I was saying with the ASX 200, I think it's worth just like de-risking by selling some of those stocks, hitting exit levels, or getting, considering getting rid of some of those ones which are maybe relatively weak, maybe below their entry price and not doing much. Maybe just cleaning up some of those things just in case this does continue to evolve to the downside, and also just being on guard in case we do get those telltale signs of a structure shift, by just keeping that. Just keeping risk in check, particularly at the moment. What I'm doing, I'm essentially balancing. I think for a lot of us, it really is. It's essentially it's a balance between holding our nerve and trying to stay with positions which are currently still well and truly profitable and still within the definition of an upward trend. It's like holding our nerve and not losing hold of good positions, but also managing risk. They're the two things we're balancing. And it can feel like a relief just to say, look, I'm out. Get me out. I'm just going to get out. I'm just going to watch everything for a while and see what happens. Problem is, what feels good often isn't right. And if this does turn out to be an unpleasant pullback and extension of the consolidation which we had been having for several months, then it can be a frustrating thing then to see the market turn higher, maybe come October, November, and then you're left on the sidelines because the market then quickly moves on without you. So that's what I'm doing, really. It's just it's balancing risk as it always is. Shut a bit down, but I'm still keeping players on the field because there's nothing here at the moment which says this is a bear market. It's a sharp pullback. It's an unpleasant pullback, but as the price action stands, it's currently not a bear market at this point in time.
Would you keep the, let's say you had a position to put on, not sell now. Let's say you've got a stock that's trending upwards out of this bear market at the moment. Would you keep the same? Would you put on the same risk as you normally would at the moment, or would you bring down that risk?
I'd be hesitant to buy anything at the moment. Oh, look, barring, say, like, if gold were to break up and the gold stocks are doing their own thing, which sometimes they do. But just in general, I'm just hesitant to buy anything just now while we have this heightened uncertainty, while we don't have a clearly defined trend. This is more likely where breakouts fail. So you can get individual stocks that break out, but it can be harder for those breakouts to stick, and they can pull back. If I were to do something now, I'd probably be more inclined to do a half position rather than a full position. So as we've been talking about, for me, I think it makes sense to just de-risk a bit and just try and not get too stressed by putting on risk at a volatile and unnerving time. Just try and dial it down a bit to let's try and see this off and see how the price action develops and wait till we get really good setups and everything starts to come back into line, which it will at some point. But it could take a little bit of time to let this settle to get some clear signals and direction.
All right, let's have a look at the Hong Kong market, which has basically been going down anyway. So
look, not much to add on the last few weeks. Last few weeks we've been talking about how it's just been giving way. It's now below 17,000, which was a support level. Yeah, look, Rog, I think just leaving this one alone, moving averages are crossing down as well. And the same goes when we look at China. Moving averages now cross to the downside. It's nothing to see here at this point.
Nothing to see here. Very good. All right. Let's start off with some questions then. Can I? Just 1 second here. 2 seconds. Can you please review QOR with respect to hitting my stop loss? QOR during a market sell-off is it wise to wait for a potential rebound to sell at a profit?
Yeah, look, I had some of this as well, which I've sold. It's rebounds are something which I try and play from time to time. It is a bit playing with fire when you play for a rebound. Like a stock like this, it is stretched below the moving averages. And there's every chance that it does have a rebound. This is what we're talking about as well. With if the ASX 200 can have a rally over the next 2-3 weeks, just bring back pare back a bit of those sharp declines over the last 3 days. Well, then you could quite reasonably expect a stock like this would ratchet higher as well. Maybe that's an opportunity to get it out at a better level. But what we've always got to be aware of, going, well, okay, that's a good plan, but what if it then quickly gaps lower and starts falling? at some point you say, look, I've got to now bite the bullet and just take it at a lower level. That happened to me recently in Bannerman. I was a uranium stock. I was playing for the rebound, and the rebound didn't come, and I just said, look, I just got to now cut it. And I cut it, and it continued to fall further. So it's like rebound, absolutely, like that's a reasonable thing to do, but also be aware you've got to have your what if. What if I'm wrong? What if I don't get the rebound? What do I do then? Because that's when people can get stuck with stocks and they go, well, now it's too late to sell. I'm just going to hold it. And then over the months that come, it continues to go lower. And they go, well, now what am I going to do? I'm now down 60% and I was up 20% or whatever it may be. So just got to be careful. Got to be careful playing for the rebound and just having some idea what you're going to do if the rebound doesn't happen and you get stuck with it, continuing decline.
Okay, can you hear me now, Jason? Because I did go
Yep.
out.
I've got you now, Rog.
Yep, it's still a bit choppy on my end, but okay. Let's. I think Makus has a comment here, but I think we sort of answered a lot of that with our commentary at the start. Your comments regarding how to approach the big sell-off, buy on the dip. Well, obviously, it's up to your plan, but they're probably not to buy at this point, according to Jason, and just stick to your ATR losses. Let's have a look at CDD, please, from Thomas.
So CDD, this is a funny one because they've had all these capital returns, so it makes a mess of the share price. What I'm going to do, I'm going to hit this adjust button, and what TradingView does, it adjusts for the capital returns. I think it also adjusts for dividends, also, so it gives you a different picture. And well, this is it's interesting, isn't it? So we've had the big market sell off, but this remains in an upward trend. So if it was and I've got stocks which are similar to this, which I'm not selling. I'll continue to hold them because the price action hasn't told me I need to sell them. I wouldn't be keen to step up and buy anything at the moment like this, but I've got stocks like this and I continue to hold them with their trailing stop. I think it's often a positive when a stock holds up despite general market weakness. It's a sign of relative strength. And I think it's probably a positive. So for me, yeah, this would be a hold.
Very good. What about MVF?
Yeah, interesting one. It's had this lovely uptrend for 18 months or so. It's I've got this one myself in my own portfolio. I was looking at it yesterday. And it's done kind of that price action we spoke about earlier with the index, in that it's had that initial decline. It's had a rebound to the moving averages, declined again. Now it's had a bigger move back into the moving averages. I thought, look, is this one to exit? But now look, the trailing stop, the way I calculate the wide trailing stop, is still giving it more room to move. So I'll continue to hold it. It is one of those stocks where the structure could be changing. We could be seeing a change from this general upward phase where buying the dip worked to we're now seeing it below the moving averages. But you see the moving averages here staying around higher again. It's also feasible that it's just part of a big sideways consolidation, which could continue playing out for months. So at the moment, it's a hold. It's not. I don't think anything much is striking me as a buy at the moment, but for me, it's still a hold. Different ways of managing the risk. Maybe if it broke below the July low, that could be a still trigger, or the motion trader wide trailing stop, which is a bit lower still, depending how you want to play it. But yeah, as I say, for now, for me, it's a hold.
Okay. What about XRF?
So this is another one which I have myself. I'm still holding it. I'm not selling it at this point. I'm using the wide trailing stop. This point it's a pullback to the 100-day moving average. Saw a similar sharp decline in May, and then that stabilized and the market started to ratchet higher again. So it's like it's everyone's got to decide like what's their objective? Are you short term, medium term? Like what's your time frame? I think if you're having a medium term focus, it's wide trailing stops and just being true to that, because the wide trailing stop. So if this turns out to be a period of unpleasant volatility, which stabilizes over the next couple of months, doesn't go a great deal lower, but just chops and is difficult, a wide trailing stop could well and truly see that off, and a stock like this could be volatile within that period, but stay above a trailing stop and then move higher. That's the objective when I take a medium-term position with a wide trailing stop. If we sell every time that the market has if you look back over the last 100 years, I think it's every couple of years there's going to be a 10% decline, and every 4 or 5 years, I think there's a 25% decline. So the big declines are out there, but there's also those 10% declines which are survivable from a portfolio perspective, where you can hold on to positions, but you can only hold on to them with the wide trailing stop and holding your nerve. But at some point, some of them, the 10%ers, are going to turn into the 25%ers, but we only know that in hindsight. So you can't manage your portfolio with hindsight. We can only decide what time frame we're playing for, and then use a strategy which is appropriate for it. And then you've got to hold your nerve through the pullbacks and accept that sometimes you're going to hold your nerve and you're going to get stopped out at lower levels. That's how it works. Unfortunately, that's the price of admission to the stock market, that we get this uncertainty, and at some point you'll get a drawdown which is significant. But we're managing the risk, always just managing the risk, and using those stop losses, whether they be closer or further away, depending on your objective.
I don't think there's going to be many stocks that we're going to look at today that aren't on the way up, right? So, not especially over the last couple of few days, and DRO is one of them. So let's just have a look at it, because that was quite in topic over the last few weeks. So.
Yeah. So it's it hit its stop loss last week. A little bit of a rebound today. I've still got this in my portfolio. It's hit the stop loss. I am, as we spoke about earlier, I've been playing it for the rebound. I've had my finger on the sell button a couple of times and then gone, I think this is so close to a rebound, and haven't done so. I didn't want to sell it into the panic of yesterday. So look, by this time next week, I'll probably be out of it. I don't think, if it has another dip low, I'll probably just have to go, look, I'm not getting my rebound. I'll just take a lower level. But if we get the rebound, I'll almost certainly be exiting into that. It's the trend is over, the trade is over. It was a great entry back in November 23, terrific run, but terrific runs come to an end, and this one has. Anyone who got in on the early signals up a few 100%, even with the significant pullback, but it's a wide trailing stop which made this significant rally possible in the first place. So it's one to. I think this isn't one to sort of like rebuy with the hope of a resurgence of the previous upward trend. I think that's over for now, and we just let this one sit on the side for some time.
Yeah. All right. Let's go through some of Talwyn's comments here. So last few days have been psychologically challenging. Yes, it has for all of us. I'm sure, Talwyn, as we go through these few days. But most of my holdings bought soon after the 58-minute crossover survived the shakeout with a wide ATR. That's great. Long-term trends remain intact. But I got a bit anxious about giving back profits for stocks greater than 30%. Decided to set a personal rule to sell half a position if there was a 50% pullback. What's your thoughts on this, Jason?
Yeah, that's like, I haven't back tested that. I don't know how that plays out. And this is one of the things we spoke about with Drone Shield. It was right at the top. It was a couple of weeks ago we were talking about it, and that was a day it was actually falling. We were talking about scaling out of winning positions, and it's an entirely reasonable thing to do, to scale out of a winning position, whether it's scale out as it's rising. If it's at a point where you think, look, I want to protect some of this profit, or if it's scaling out as it's coming back before it hits its trailing stop. There's nothing wrong with doing any of those things. They're all risk management things. It's still about letting profits run, trying to maximize our upside, and having a scale out at some point is fine. We've got to be able to sleep at night, and if your portfolio is such that it keeps you up at night and you're too worried about it, it's there's going to be anxious times, of course. But if they're just over the top, you've got to look at look, how do I just turn the volume down on this a little bit, and sometimes some of those scaling strategies can help. If a scaling strategy helps you better stick to your trading plan, I think they're especially good, because I think the worst thing people can do is they've got a great plan, but volatility just scares them out of their plan, and they shut up shop and they can't follow it anymore. Whereas if they added in a few tweaks, like buying half positions or scaling out when there's a big profit, it just makes it psychologically a little bit easier or a little bit more palatable to stick with your strategy, and that helps. By all means, I think that's a sensible play.
Yeah, what's your thoughts about, like, I've had people tell me about, if their position's in profit, their initial investment, they scale, or, by more than that, obviously, they scale out just that initial investment and leave the rest in. Have you ever done anything backtesting around that sort of strategy at all? Or
I know people use it. I know people who are really successful use it. I prefer not to use it. The way I used to look at strategies like that, but what I found is, like, I'd look at it and go, okay, well, like, say a stock's gone up, I bought a stock, it's gone up 10%. I moved my initial stop to break even, and what is it? You sell. What are we doing? We're
sell the number of stocks that's needed to. So if you're going a negative again, obviously you've still got your remaining capital.
So the idea is to break even. So you sell some of your stock and adjust your stop loss so that the net position is going to be break even. Yeah. And it sounds really attractive in theory, because you get this free trade. The difficulty, the challenge for me is that, though, when you get a stock that goes really well, so say it's 10%, you've done some adjusting, you get your free trade. What if the stock then goes up 200 or 300%? So what you're doing, your best trades are going to be half strength, because say you've sold half to give yourself a free trade. So your best trade, which has gone up a couple of 100%, is now half strength. But then you buy another stock which doesn't go up at all. You buy at the high and it heads back down to your stop loss. Your losses are full strength. So you've got full strength losses and half strength big wins. So I didn't quite, while the theory of a free trade sounds good, the practice of it didn't quite work for me. But some people use it and use it really well. So it's for everyone to think about. That's just how I thought through it. The back testing I've done works best when I just have the whole position and let it run. But these are all thinking points. Everyone's got to know themselves and know what's going to work for them. And if taking some early money off the table helps them stay with their overall principles of letting profits run and wider trailing stops, well, maybe that's a compromise which needs to be made.
Can you backtest these things in software, Jason? Can you backtest that sort of thing?
Yeah. In the software which I run Motion Trader through, it's backtesting software. So it's software where you program in the rules and you get the data and you put all the data in and you test the principles out over, or not even the principles, the specific rules. You test it out over time. So I've got, my data goes back to about 1992, I think it is. So a bit over 30 years worth of data, and that's good. I think you want lots of data when you do testing, because you want to see how a strategy works over several market cycles. If you just get a 2 years worth of data, like, what do you have? Do you have 2022 where the market went sideways, or do you have the last from October through to March where the market just went up, or do you have a bearish phase? And you've got to have the whole cycle, otherwise you don't really know, like, does this work or does it not work? Did I just get a snapshot of time which was favorable or unfavorable? So lots of data, lots of cycles, and you see what works over time. Nothing works all the time, and you get lengthy stretches where a good strategy just is going to be out of sync. But that's what I do to give confidence in the approach that I use.
All right, let's go back to some stocks here. Hope that answered some of your questions, Talwyn. TG6, please.
Well, this is not the sort of stock I'd want to be in at the moment. Look, it's just a downtrend. Like, I like to say something positive when someone pulls up a stock. I don't like to just go, I don't like it, but I don't like it. It's making new lows. The moving averages are pointing lower. It's been in a downtrend for some time, so it hasn't been a stock for me to consider. And there's not even, I can't even say, look, there's sometimes we look at these stocks, say, look, it's not for me, but I can see a trade. You could buy it here, and this is where I put the stop loss. This one is just making new lows now, so I can't even say, look, I'd buy it here and I'd give it a stop loss below this previous low, because it's just making new lows. So I want to buy stocks which are on the other side of the moving averages, basically, and when they're on the wrong side, which this one is, I'd rather just stand clear.
I like how you're trying to find the silver lining in every stock, Jason, but sometimes it's better just to be honest and say, no, there's plenty of other opportunities out there, right? So TIG, please.
TIG. Well, this is basically we could just, if I've got the right stock, TIG, it's a really thinly traded stock. You can see it barely, often doesn't trade, but it looks like it's a stock which is not going to be around much longer. 0.4 of a cent.
Yeah, wow.
So this is even, all my comments from the previous stock, overlay them with this one, and it's not a stock I'd be considering.
All right. DOU.
Was that DIU?
DOU. DOU. DOU.
Where are we today with all these low price stocks? Another 0.3%. Look, it's the same comment as the last two stocks. We've got these declining moving averages. It's you're just swimming against the tide when you're buying stocks below these declining moving averages. And I think probability does not favour you when you do that. It's like, sure, a lot of stocks will bottom, and they'll bottom when they're below their moving averages. And if you get them at the low, well, that's great. But all too often, they just keep going, and you keep holding, and they just keep destroying capital. I'd just rather leave them alone completely. Again, it's thinly traded. Sorry, there's no. I just don't see any play here whatsoever.
All right. What about RNU?
There we go. Is that what's that? 8 cents. Look, it's similar to the others in that, again, we've got these declining moving averages. The difference with this one would be you could possibly say, just looking at these previous lows, saying, look, it's coming back, it's testing the previous lows. I don't think this isn't a play which I'd want to use. This is very much trying to pick the low, but at least with this one, you can try and pick the low around some set levels. So you can see this blue shaded area picks up all these previous lows. So someone could say, look, I'm going to buy it at current levels, and I'll sell it if it breaks below those previous lows. and that is it's a 20% stop loss. So say you say, I'll give it the previous lows plus a bit of extra room. 20% downside if they really like it for some reason. Look, it's the sort of stock which it could double. Maybe it could rally 100% with 20% of risk. So there's a possible play there. It's but again, I stress it's not the sort of play I want to do. But unlike the previous two stocks, we have some chart structure to work with. We have some previous lows which are nearby, so you can sort of calculate a risk point and go, okay, I like it for whatever reason. I can see a risk level that I can use. If everyone sees what I see and it takes off, great. I could do really well, but I know how much I'm standing to lose if it doesn't play out.
Yeah, and just remember, obviously, if you're watching this for the first few times, we are analysing these stocks from purely a technical point of view, reading the charts, and if you're looking at them from a fundamental view and you like the company for whatever reason, then obviously that's another play in itself, right? And you have to do your own due diligence as always. We're only just providing general advice, right? So stocks MGH, please. Stocks MGH.
Sideways trading range. Uptrend still intact with this one. It's just oscillating either side of the moving averages at the moment. And this is a motion trader stock. The signal would have been probably back midish last year, and we've really just got this general ranging period at the moment. So it's interesting that it has held up fairly well, I think, over the last few days. Be well above its trailing, well, reasonably above its trailing stop. So if this were in my portfolio, I'd be holding it.
Okay, fantastic. VNT.
Uptrend remains in place. Pull back to the 50-day moving average. Did get a bit stretched above the moving average, and now we've had that pullback, which so often happens. You can see how it got stretched in earlier in the year, got ahead of itself above the moving averages, and as it did at previous times as well. When something really starts to get away from the averages, you can be sure, unless the stock stops trading for some reason, say it's taken over, it is at some point going to come back to those averages, and it has now. So what happens from here? Maybe I don't know. I don't know what happens here. Like it could trade sideways for several months and form a new platform and turn higher. It could do any number of things. Of course, it also could just start to lose momentum now and start to fall away. But there's a trailing stop strategy should that happen. Well, that's what I'd do with it anyway. I'd have a trailing stop strategy. If it continues to come back, there'll be a level where I say, look, enough's enough. Time to leave the field. But at the moment, it's an uptrend which has a pullback, and pullbacks are a part of being in the stock market. So for me, it's a hold.
Okay, all right, let's go switch back to a question here. When do you derive your trailing stops? Do you base on intraday or closing price? I feel there's wisdom in erring on intraday. Even if it's a false signal, there's always other stocks to buy.
So is the trailing stop, does it work on a closing basis or an intraday?
Yep.
Yes. Yeah, I use intraday. I'm kind of doing both in a way. So my level's calculated intraday, but I don't look at it until the end of the day when I go through and I run the data and I just see what happened during the day, because I don't set a live stop loss in the market. It's I just manually sell them after they've hit the stop losses. It's I come from a background where I traded currencies and futures markets, and with those it would be a live stop in the market all the time, and it'd work on as soon as the stop is hit. Doesn't matter what part of the day it would be, the position would be closed, because that's because they're often leveraged positions, and leveraged positions can cause a whole lot of trouble if you just let it, just wait until the end of the day to see what's happened. With a portfolio of individual stocks which are unleveraged, I'm a little bit more relaxed with having a look at it at the end of the day. But for deciding whether I should sell or not, I do use the intraday touch as my trigger point. I think if you back tested both strategies, I don't think there'd be a huge amount of difference in the overall outcome. It might be a little bit like using a simple moving average versus an exponential moving average. They're a little bit different, but they're similar, and the overall outcomes should deliver, I think, a pretty similar result.
Yeah. So just to be clear, if you're watching a stock, let's say that's going through your stop loss that's been set already, the stop loss level, if you're watching that through the day, you would sell it at that point once it goes through it during the day, or you're waiting for the next day to sell it once it's closed?
It'd usually be the latter, because sometimes I'll look at a stock and I'll see it's had a bit of a move, and I'll look at where the stop is. I go, oh, it's hit the stop, I better sell it. More often than not, though, I don't notice these things. It's like 50 to 80 stocks in my portfolio. So I don't sit in front of a screen all day just watching everything move around. I don't have like 80 call levels or alert levels set in. I'd be forever just updating things. So more often than not, it's a case of I'll run the data, I'll see what stocks have hit exits, and then I'll move to sell them the next day or soon after. I might try and finesse the sale a little bit, as we were discussing earlier. But yeah, it's generally the next day or soon after. Sometimes on the day if I happen to notice something, but yeah, I've got to notice it. There's a big portfolio which is unleveraged. There's not a need to watch every movement and every stock all the time.
Yeah, I like this comment here. You can't back test the effect of maintaining your psychological capital, unfortunately. That's a good one. Right? It's one to think about. I think that's the saying of the day.
It's such a good comment, because everything seems so easy in the back test, and it's and I look at this and I look at, like, I'll test a strategy, and I'll look at the drawdown profile. Like I look at, like, I can come up with a strategy in back testing that is just amazing over 30 years, but then you look at the drawdown profile and it might have 50 or 60% declines, and it's like, yeah, people go look at the headline return and go, wow, I want to trade that. But you got to look at it and go, be honest with yourself and go, but can I stomach 50 and 60% declines? And for most people, they can't. So, and you can't, as the comment is, you can't back test it. You got to try and know yourself well enough to go, look, what do I think I can do? And then you got to put yourself to the test and see whether you can do it. And I think the best way for most people to stick to a strategy is just keep position size relatively small. Don't get carried away with large positions. Like, people often think, if I want to win big, I got to bet big. That's not necessarily true. Many relatively small trades where you keep your risk for any one stock, maybe it only might be 0.25% of your overall capital, or 1% of your overall capital. It's like, a loss isn't that earth-shattering. But it's when people have these huge positions, and it really gets difficult. So know yourself a bit, and then keep your risk. Try and be maybe a bit conservative with your risk, and that will help, I think, stay the course. And if you can tolerate that, well, then you go, okay, look, I can turn the heat in my portfolio up a bit, because I got through that bear market, and that was okay. So maybe next time round I can have a little bit more risk on board. And you can't back test yourself, but maybe that's a way to test yourself in real time in a way that hopefully you can come through.
Yeah, I think, well, thanks for that, Kirby, because I think, once again, that just shows, I mean, to me, that's a comment around the fortitude that you need to be an active investor or trader, whatever you want to call yourself, right? Everyone thinks it's easy, but it's certainly not, right? Otherwise, everyone would be doing it, as the saying goes, right? So let's go back to have a look at RUL, please. RUL.
Yeah. I've got this one in my portfolio. I continue to have it. I've got no plans to sell it at the moment. It's above the trailing stop. So the wide trailing stop helped see off this sell-off in July, back above the moving averages. Like, I don't know where this one's going to go in terms of, like, is this like the first part of the trend chain? We've had the rally and it's going to start to stall and come back down. That's my that's my concern with it, I guess. If I've got a concern with it, it would be like, it's losing momentum. It's having to buy the dip, but it's stalling, and next move is down. My feel is that, that's probably where I think this one could go, but I'm not. But I could be completely wrong, and I know from experience that I should just follow my process, which I am with this. I'm not selling it. If I want to shut down some risk, this would feel like one. Oh, look, I can just. This one looks like it's stalling. I'm just going to take it off the table now. But so often when you do that sort of thing, it then starts to continue to rise, and you go, oh well, how I was on board, and I broke my rules by selling it early. So maybe this would be a scale out one. If somebody wanted to do the scale out, say, look, I'm not so sure about anymore. Maybe I just halve the position on it. So I'll keep some in play, but take some off just in case it does come back to the stop loss or trailing stop. But for me, it's a hold.
All right. I think we've sort of exhausted the stock picks for today, Jason. I think we're just on time as well. There's a good, a bit of a strategy there to get out of stocks on the strength there from Kirby, if you want to have a read. But thanks again for our 1 year anniversary show here, Jace. I'm just going to do this imaginary party popper, boom, and then celebrate afterwards with a cup of coffee. Again, another cup of coffee. Jace, are you off for your run now, or? Yeah,
I'll do something like that. It's been a big day for the anniversary show with the markets flying everywhere. So yeah, look, that's been good. I think a bit of and that can be a good thing to do when the markets are volatile as well. Don't sit there and look at them all day. Get outside and just try and maybe turn the heat in the portfolio down a bit. And easier said than done, but try not to get too worked up about it, because what we're seeing now is not unusual. It's it is an extreme 3 days, but it's not unusual for the stock market to do things we don't often see. But we often do see pullbacks, 10% pullbacks. It's all part of it. It's unpleasant, but it's part of it. So let's just see how it develops and come back and talk about it next week.
Exactly. Thanks for your wise words of wisdom as always, Jason. Don't forget to stop. Don't stop trading. Obviously, on selfwealth.com.au. If you haven't signed up, you can just sign up through the links down the bottom. And then if you want to hear more of Jason's wise wisdom as usual, you can always go visit him at motiontrader.com.au. Thanks again, everyone, and we can't wait to see you again next week. Have a great week ahead. Take care. Bye-bye.
Thanks, everyone.